Hello and welcome to Big Deal. Now today let's discuss some of the significant changes in the way deal making is progressing in India and the recent trends really picking up. With Manisha Girotra of Moelis, India. Manisha, always a pleasure to welcome you on CNBC-TV18. Now, my first question, looking at the data for this particular year in terms of deals, both in terms of value and volumes, it had been on a slow lane for the rest of the year, but we have seen some pickup in the month of August. How is everything forming up for the rest of the year? And what do you think are the key drivers for deal making in terms of M&A and private equity deals?
Thanks, Nisha. Thanks for having me on the show. I think if you compare M&A trends from last year to this year, I think there were two large trades that happened last year, if you remember, Nisha. One was the Adani Holcim trade, and the other was, of course, the behemoth HDFC Bank merger. That sort of makes the volumes this year compared to last year look anemic. But if you were to put away those large two trades and remember what's happening in the global markets, in the way that the volumes are down, if you look at, just giving you a quick statistic, last year, global equity volumes were around $300 billion year to date. This year, they're around $160 billion. So down a significant amount. Europe, Canada, US, down 60 to 70%. In that context, if you look at the global deployment of capital into India, it's not fallen so much. Last year, we had deployed global investors had deployed about $65 billion. This year is about $45 billion. So it's not that steep a fall. And in fact, within Asia, India's share has gone up from 15 to 20%. Coming back to your questions, yes, the deal flow probably in the earlier half was slower just because what was happening globally. Investors were worried, private equities sitting with about $3 trillion of capital, but just wasn't deploying. I think a lot of that hesitation is behind people, just as India has stood out. Our growth and GDP numbers have shown that, we are actually defying what's happening in the rest of the world. And you're seeing plays and investments happening in India, both by domestic strategic players and by global private equity and strategic players. And the only thing that's changed dramatically, Nisha, which is good and which is a structural change, is that earlier investments into India were just for companies which didn't have too much regulation or were exporting to the rest of the world. Today, basically, it's far broad-based investment.
That's right. And Manisha, you mentioned about private equity action. Well, there's enough and more action, even if it was not for so many acquisitions, but definitely the equity capital market, transactions in terms of their exits have been amazing in terms of the numbers. The sheer volume has been unheard of and has been the highest. What do you make of this kind of exits that the private equity investors have made? And and at these valuations, will they also invest with the same enthusiasm?
So, Nisha, I think you raise a very good point, which is that, till 10 years ago, exits of larger size and scale were a huge issue in India. When we went to pitch to the large investors, it was always this mythical strategic, or then, look at doing an ADR or a GDR if the investment size had gone beyond $300 to $400 million. Today, there are different ways at which you can actually, exit your investment. First, private equity to private equity deals are happening. You saw Hexaware being bought by Carlyle from Barings. Quest Technology recently also bought by Carlyle from Advent and Bain. So that route of private equity buying larger stakes from other private equity is a well-established route. But I think the most heartening and the most positive route is what you mentioned, which is that public markets in India are basically buying into these large exits. You saw a company like Coforge, which Baring sold recently. It was $1 billion block. You saw Everstone selling its 25% stake in Burger King, and these were done overnight. So that's been a really positive change because we just didn't have that market as an exit. And more importantly, Nisha, in that market, you're not just seeing foreign investors, but domestic investors buying into these companies. You can argue that some of the price leadership comes from the foreign investors, but domestic investors, high net worth individuals, family offices are coming in size and scale. And even at a time when the market looks nervous, they're coming in and deploying large amounts of capital. So it's becoming a very healthy exit market. And that's really important because, while entry is great, I think most investors invest because they want to show an exit in 3 to 4 years. And today, India is able to provide that.
That's right. A very important point that you raised, Manisha. Has this, in your recent conversations with some of the large private equity firms, has this really come up that this exit opportunity is looking very good for the Indian, investments, and also is giving them a lot of confidence about investment? Are they now looking more confidently towards India's large ticket acquisitions as well, Manisha?
Sure, Nisha. I think, look, exit is an important part of the thesis for any private equity investor. But I think what's more important is the structural changes that have happened in the domestic market, right? The markets come of scale. Today, India is the fifth largest domestic economy, large consumer base, so all of those reasons investors are wanting to invest in India for in India. So that's an important trend for which investors are looking to come into India at a time when global growth is sub 1-2%, and we are arguing between ourselves on 6 versus 8%. So I think investment in the market for the sake of the market, but of course, Isha, the fact that you can exit so easily overnight, large stakes really helps the investment case.
That's right. India's, capital markets have given a lot of confidence to the private equity investors. Now, in my recent conversations, Manisha, also each of these marquee investors are also increasing their deployment towards India, higher in rate than compared to some of the last few years that they have ever invested. Where is that money going to go into? Are these going to be the similar healthcare, IT, as well as some of the consumption, the usual bets, or are they even looking at newer bets? What are you gathering?
So, Nisha, I think there's been a significant structural change. As you said, initially, the investments firstly came into IT because that was seen as the safest sector. We were the office to the world, and it was a well-established sector where we had global competitiveness. Then it moved more into sectors such as healthcare. But if you dice the data of 2022 and 23, you will see that 60% of the investments from private equity and sovereign wealth funds is now going into traditional sectors such as banking, financial services, pharma, healthcare, etc. And the sectors which are really suffering are the ones which did very well in COVID, such as the consumer internet stocks, etc. I think those are seen in anemic investments, but investment has become more broad-based just because of the structural changes that have happened in India. The markets become larger. The sector, a lot of the manufacturing has got formalized, so there isn't irrational competition from the unorganized sector. So investors are willing to make larger bets. And you have the last mile connectivity through the fabulous digital public stack we've created, the regulatory clarity that we provided through difficult reforms such as GST, etc. I think for all of those reasons, today investments are far more broad-based across sectors. And not just that, Nisha, they're also coming from a lot more geographies, right? Till 5-7 years ago, most investments, as you know, came from the US and Europe. Today, Middle East, Canada, Singapore are all become important geographies which are putting large checks. And these are patient capital. They're not looking for exit 3 to 4 years from now. They are investors who are investing in the country for 7, 10, 15 years. And that's very positive because some of these sectors that we are talking about, such as infrastructure, need long gestation capital. And, we are, as a country, need to attract more foreign capital in those sectors, and we are doing that now.
Right, and other sectors like consumption, Manisha, that's also found new meaning with many investors. Like there was a time when financial services was seen as a quasi-consumption, and we have seen enough investments into that. How are you seeing the entire consumption basket with private equity, investor interest, and also M&A?
So, Nisha, as you said, urban middle class, 400 million expected to go up to 1 billion by in the next 25 years. So, really strong consumer middle class, which is demanding better services and products for their families. So, till 5-7 years ago, the reflection of a strong consumer market was that are we buying into FMCGs, are we buying into durables, but no longer the case. I think that today's urban middle class is wanting better services, better healthcare, better education, better travel experience for his or her family. And that's resulting in large investments happening in sectors commensurate with that. Healthcare services, hugely underpenetrated sector. You saw the large Manipal transaction happening, $2 billion from Temasek. You saw CVC buying into HCG. You saw Blackstone buying into care hospitals. And then Manipal continues to consolidate. So it's not just the global investors, but domestic investors too are looking to consolidate this sector. Also public market IPOs of companies such as Medanta. So I think, the consumer behavior today is you just don't track it just by the FMCG and consumer durables and say whether it's looking good or not, because the consumers become very savvy and wants better services. And that's really where the investment is coming, both from the private equity that you mentioned, as well as the Indian strategics in the country.
Right, and also another offshoot of consumers that we saw pick up in a big way was from the startup space. Now, what's your view on the funding winter? Are we seeing some bit of revival there? Is there an M&A action or consolidation that you foresee there?
Sure, Nisha, I think, look, till last year, there was a lot of fraud. India has 90,000 startups, of which 7,500 are funded, 100 were unicorns. This year, only one unicorn's been created. So I think there was too much fraud, too much money went in. You just had to have an idea and you could get funded. I think all of that's out of the window, and that's a really welcome outcome. What you saw in this last year is, as equity and debt became scarce for these companies, that the ones that have come out on top are the ones who basically went through structural changes, basically brought their costs down, brought their efficiencies down. The competitive scenario became more sensible. You saw the likes of Swiggy, Zomato, build much better business models, build adjacencies. You saw Paytm after the IPO debacle that had happened, that it came back with a much more sensible business model. So I think some of those who basically are now coming up with smarter business model, have the last mile access, are building adjacencies, have not just a path to profitability, but are profitable, are the ones that are going to be the winners. And like every other sector, I think come 2024, you will see the winner taking it all in this sector too. In retail, you saw Reliance Retail get a large investment recently from QIA and KKR, and there's more to come, as I hear. So I think the winners in every sector will basically either become consolidators or then get disproportionate access to capital, and the smaller players will then die out, which I think is a welcome change. It's the same trend, if you recall, we saw in telecom, in media, other sectors, the deeper pocketed in, companies with sensible business models and a sensible competitive landscape are the ones that came out as winners and got access to capital. So come 2024, I expect more activity, but at reasonable valuations. You saw some down rounds happen already in likes of Farmeasy, etc. I think you'll see the larger players consolidate the smaller players in 2024, or then some of the smaller players themselves consolidate, or some players who have some niche, access to consumers or have some niche technology will get bought out by the larger players.
Right. So consolidation by some of the smaller players perishing is also one of the things that you mentioned. Now, my final question to you, Manisha, you have a huge interface with the several promoter groups, large business houses. The M&A activity over there among strategics, maybe because of succession that we have seen in one of the cases as well. And apart from that, the animal instincts of the Indian corporates to do M&A for growth. How are you seeing that particular centimeter working out right now?
So, Nisha, good question. I think till 5 years ago, if you remember, the only Indian companies that sold out were ones that were being compelled to sell out through the NCLT process. Large conglomerates sold their businesses because they were leveraged. I think if you want leverage, there was no question that an Indian promoter would sell their business. That's no longer the case. If there's a generational issue, promoters are willing to exit their companies. You saw that in JB Chemicals, in Bharat Serums, sold to Advent, in SL Packaging, sold to Blackstone. So there's no longer that stigma. And valuations are rich, and both domestic strategics and private equity are vying for these businesses and willing to pay top dollar, because creating greenfield is very difficult and the market's too large. You want to address a $5 trillion market, you don't have 5 to 7 years lead time to build out new businesses. You're willing to pay that top dollar if you're a domestic strategic also. So I think a lot more activity you'll see in that. And a lot of these families which have sold out now run very successful family offices and are investing into the equity market. So it's turned out very well for both the seller and the buyer, and we are going to see an increasing trend of this as generational, families do not want to necessarily continue in the same business.
All right, many talking points, and looks like that the Deal Street view is going to be robust for the rest of the year, and you're going to be quite busy with that, Manisha. Thanks so much for joining us here and giving your insights on the Deal Street view and how the rest of the year is going to look like. Thank you so much.
Thank you, Nisha. Thank you.
All right, with that, we'll slip into a short breather on Big Deal, but don't go anywhere. Our special segment, Court Corner, comes up next.